Hello, everyone, and welcome to the Nelson Roberts 2020 fall presentation, Flirting with Euphoria. For those of you who have attended this event in the past, you know that it's typically an in-person event. We enjoy face-to-face meetings with our clients and the interaction that brings. We've moved this to a virtual event this year for obvious reasons, but on the bright side, many of you here today may not have been able to attend in person, and we're happy to have you. We continue to work remotely and limit the numbers in our office to keep ourselves, our employees, and our clients safe. So apologies in advance if you hear any babies crying or dogs barking. Before we get to the presentation, I would like to quickly introduce the Nelson Roberts team. On a panel to answer your questions today, we have the Nelson Roberts partners, Brooks Nelson, Brian Roberts, Steve Philpott. Your presenter will be Darcy Nelson Smoot, the Director of Research for Nelson Roberts, and I am Evan Nelson. Also on our panel, we have Ann Oglesby, our resident medical expert, to answer any technical questions you may have about coronavirus or a vaccine. Chrissy Domingo is one of our rising star junior analysts, and we've got a great wealth management support team, and Sarah Sinclair, Aaron Rodriguez, and Marissa Wisniewski. We also have a new addition to our team this year, and Tiffany Young. You may have spoken to her if you've called into the office. The format will be slightly different this year. Typically, we encourage a conversational format with questions throughout, but this year we're going to hold all Q&A until the end. If you have a question, please click the Q&A box at the bottom of the screen and type it in. And for those of you that would like to get a copy of the presentation slides, please contact one of us after, and we'll be happy to send them to you. And with that, I'm going to turn things over to Darcy Nelson Smoot.
Thanks, Evan. Welcome, everyone, and thank you so much for joining. I know I'm looking forward to when I can see all of your smiling faces in person as soon as it's safe, but hopefully this virtual presentation will give you a little bit of insight into what we're thinking in terms of the market environment and hopefully answer any questions that you may have. So today we're going to talk about the stock market recovery, the upcoming or potential economic recovery, and some of the portfolio actions that we're taking at Nelson Roberts. So let's talk about asset class returns. This chart is showing returns for the third quarter in the light blue bars and returns for year to date in dark blue for the various asset classes. So broadly, the third quarter was positive. Let's focus in on the year-to-date numbers to see where everything stands. Small cap companies have been the worst performing group, down over 15% year-to-date. Smaller companies tend to have less cash on the balance sheets, which makes them a little bit less well prepared to deal with crises like the one we are experiencing this year. International stocks have also underperformed and are down. Both the developed international and emerging market indices are negative year to date. Both of these have underperformed large cap US companies, which are represented by the S&P 500. The S&P 500 is really the index that most people are referring to when they talk about the stock market. It, as you can see, is the best outperformer this year, up just over 5%, which is the greatest performance out of the equity indices. Over here on the right, the Barclays Intermediate Government Credit and Barclays Municipal Indices tell us how bonds have done this year. Bonds tend to do, they're a safe haven for investors during turbulent times. So they've done well in 2020, which has seen plenty of turbulence. From a sector perspective, this chart is showing the 11 different sectors of the S&P 500. And similarly to the last chart, we're showing the third quarter in light blue and year-to-date returns in dark blue. Really what stands out to me just by glancing at this is the very wide range of dispersion between the top performers and the bottom performers. Energy is the worst performing sector year to date, hands down. This sector is down almost 50%. Energy stocks tend to trade along with the price of oil, and oil has had a couple of issues this year. On the demand side, when the pandemic hit in March, there was a steep drop off in global demand, which impacted oil. On the supply side, a price war broke out earlier this year between Russia and Saudi Arabia. Both countries were pumping out oil and contributing to an oversupply. Financial companies have also underperformed and are down about 20% this year. This sector includes companies like banks that tend to lend out money or other companies that do well when interest rates are high. When the pandemic hit, the Federal Reserve brought its target interest rate down to 0%, and interest rates have really been falling everywhere, which has impacted financial companies adversely. At the top here, technology stocks have done great. The technology sector is up almost 30% year to date. We are now, we've all kind of become accustomed to this mandated digital lifestyle, and technology companies have played a part and have benefited from that. Consumer discretionary as a whole, the sector is up about 25% year to date. What's interesting about this sector is that it does include many of the traditional retailers, which have suffered in this pandemic as foot traffic to retail stores has declined and has depressed sales. But there's one retailer, it's an e-commerce retailer, makes up about a quarter of this sector. I'd be willing to bet that every one of us has probably made a purchase from this retailer in the last 7 months. If I had you all here in person, I would ask you to raise your hand and tell me if you thought you knew which one I was talking about, but I will just go ahead and spoil it. It's Amazon. So Amazon makes up a quarter of the consumer discretionary sector. It's an e-commerce company that's done incredibly well this year, and it's actually pulled the entire sector higher along with it. So 2020 has been an interesting year, to say the least. This chart is showing the S&P 500 going back to the beginning of the year. From February 19th to March 23rd, the S&P 500 fell 32%. This was the fastest bear market of all time. In just over a month, the shortest month, in fact, the S&P fell 32%. This was an unbelievably steep, sharp decline in a very, very short amount of time. From March 23rd to September 2nd of this year, the S&P rose 60%. This was the fastest bull market of all time. Some of those gains were given up through the month of September, but in general, the market, the S&P 500 is back to where it was before the pandemic started. So why is this? Why do we have a miraculous market recovery so quickly? Fiscal and monetary stimulus. We've seen really unprecedented, I apologize for using that word. I know it's probably the most overused word of 2020, but there's no other way to describe it. The fiscal and monetary stimulus has been unprecedented. So the federal government stepped in early, provided a very large amount of stimulus. The Federal Reserve also stepped in to support the capital markets and maintain liquidity, and that has contributed to a stock market recovery. We've seen progress on the vaccine front that's led to optimism that there might be an end in sight to this pandemic. The previous land speed record for bringing a vaccine to market was about 4 years, and that was for the mumps vaccine in the 1960s, 1967. Now, of course, there have been quite a few developments in healthcare since the 1960s, not least of which was the ability to sequence the DNA of the virus early on. But to have several large biopharma companies bringing a vaccine to a phase 3 trial within a matter of months is really nothing short of spectacular. FOMO and TINA. You may have heard about these terms, you may have read about them or heard about them in other contexts, but FOMO stands for the fear of missing out. Nobody wants to be on the sidelines missing out on a big market recovery, and that fear of missing out has driven investors into the equity markets, which has propped up stock prices. TINA stands for there is no alternative. I mentioned earlier that interest rates have fallen. What that has led to is very, very low yields on bonds in the bond market. So with unattractive investment prospects in the bond market, there really isn't an alternative to put excess cash on the sidelines other than in the stock market. Corporate profits have been better than feared. Now, that does not mean they have been good, but when the pandemic hit in March, basically every company out there said, we have no idea what this is going to mean for us. So companies traditionally give guidance in terms of what they think they might make for the upcoming year. In the first quarter, or when, in March after this hit, almost every company in the S&P 500 withdrew their guidance. So all that was left was uncertainty. The market hates uncertainty. And all we had were kind of worst case projections. Now, fast forward, we've gotten second quarter results. We've gotten third quarter results from some companies. And we now have a little bit of visibility on, how bad was it? Well, like I said, it was not good. But in general, corporate profits have been better than those worst case scenarios that were originally put forth. And finally, the 5 largest holdings in the S&P 500 have pulled the market higher. And I will talk about this in a couple of slides. So many of you have been to our presentations before, and so this may not be the first time you're hearing this quote, but Sir John Templeton said that bull markets are born on pessimism, develop on skepticism, mature on optimism, and die on euphoria. So we've applied these terms to valuations on this chart. So this chart is showing the price to earnings ratio of the S&P 500 going back to about the mid 90s. So the most obvious sign of euphoria was in the dot-com era, which was in 2000 at the height of the dot-com bubble. Now, if we look at where we are right now at 26 times earnings, we're about back to where we were in 2000. So you might be saying to me, Darcy, why are we saying flirting with euphoria? It looks like from this chart that valuations have blown right through optimism, and it looks like we're doing more than flirting at this point. It looks like euphoria might be bringing us home to her parents at this point. So it's a good point. It's a good question. In this case, this year, earnings have fallen so quickly and so sharply. And earnings is the denominator in that price to earnings ratio. So it's kind of a math problem. When your denominator falls really quickly, you're going to have a spike in valuations. So we saw something similar in 2009 during the height of the financial crisis, which of course was not a euphoric time. However, the stock market has recovered. 26 times earnings is extremely high. And whenever we get back to normal, whatever that looks like and whenever that happens, this valuation will have to come down. Now, whether that occurs from a very sharp rise in earnings or whether that occurs from a drop in stocks, only time will tell. But at this point, taking everything together, we believe we are flirting with euphoria. So we have seen a stock market recovery. We have not seen an economic recovery. The stock market and the economy are not the same thing. So it remains to be seen, what's the shape of the economic recovery going to look like? Is it going to be a V shape, which is a very, very sharp decline followed by a sharp increase back to normal? Is it going to be a U shape, where you kind of spend a little bit more of time at the bottom before an eventual recovery back to normal? Will it be a W shape, where you have fits and starts and increase, decrease, and increase in kind of a rocky road back to normal? We actually think we're going to see more of a K-shaped recovery. This graphic is from the Wall Street Journal, but really illustrates our point perfectly. In a K-shaped recovery, you've got one group of people, higher income earners, that are able to work remotely, probably haven't seen much in the way of income or wage disruption, might even have stock portfolios, which we've seen those have certainly recovered. That group will recover and will do well. On the other hand, you have lower income workers, maybe service employees who've seen their hours or their wages cut, or may have even lost their jobs. That group is going to take much longer to recover. We've actually kind of interestingly seen a K-shaped form in the stock market as well. This chart is showing the S&P 500 growth ETF in blue and the S&P 500 value ETF in orange. Growth stocks are typically those that probably trade at higher valuations with the expectation that they will produce more growth in their earnings. They often don't pay a dividend, whereas value stocks are usually more established companies. They trade at lower valuations. They're not really expecting a ton of growth in their earnings. And so to compensate for that, they often pay a dividend. In March, there was kind of a great equalizer. Growth, value, everything, every single thing was down. But coming out of this, coming out of that bottom on March 23rd, growth stocks have recovered and then some. So their growth stocks are up over 21% for the year, whereas value stocks really have not yet recovered. So they are sitting down about 11.5% year to date. Now, value stocks do typically include financial companies and energy companies, which do have legitimate reasons that they are down, whereas growth stocks include the technology, some consumer discretionary stocks, which of course have reasons to be up. But nonetheless, it has not been a universal recovery for every stock out there. So I mentioned earlier that the top 5 holdings in the S&P 500 have helped contribute to this market recovery. Amazon, the quaint little e-commerce retailer that I'm sure we're all familiar with, up 70% year to date. Apple, essentially technology hardware, everyone rushing to set up remote school, remote work environments has benefit Apple, which is up about 60% year to date. Microsoft is up about 34%. Anyone trying to work from home knows how vital Microsoft's suite of products and services are. Facebook up 27%. Less time spent out in the real world means more time spent on social media platforms. And similarly, that's benefited Alphabet, which is the parent company of Google. Now, this dark blue line here, this is the S&P 500 equal weight. So stepping back a minute, the S&P 500 that we know and love is a market cap weighted index. So what that means is larger companies in the index have a disproportionately higher effect or contribute more based on whatever their return has been. The equal weight index is kind of just like it sounds, as if you took every single stock, all 500 companies, and just weighted them exactly the same. Now we saw earlier that the S&P 500 is up 5% year to date. If we look at the equal weight index, it's actually down 6%. So these top 5 companies have really, really outperformed and have helped propel an entire index higher. Now, if we look at, well, what percentage are these companies of the S&P 500? They combined make up 23% of the index. That is 5 companies that make up almost a quarter of the entire index, and then 495 other companies that are the remaining 77%. This is a very high amount of market concentration. Now, of course, these companies have very legitimate reasons that they've all performed well, but the level of concentration is now rivaling that we've seen last in the dot-com era. Not really the same thing. Of course, these are profitable companies that do produce plenty of cash, but it is something that we are watching, especially because the more concentration you have in a couple different stocks, the more adversely you could be affected holding an S&P fund if Apple, for example, had some reason that it was down 50%. So we've talked thus far about the anatomy of the stock market recovery. We're going to switch gears a little bit here and start talking about the economy. Most economic data is published monthly or quarterly, but with the technological advancements that we've had, we can actually scrape data from Apple Maps, OpenTable, things like that can give us higher frequency, at higher frequency intervals, we can kind of put our finger on the pulse of the economy. So this chart is picking 6 of those high frequency data trends and looking at them going back to February before the pandemic hit. Purchase mortgage applications in dark blue, this is kind of a reflection of the housing market. And of course, there was disruption early on when everything shut down in March. But for the most part, that mortgage applications have recovered and are actually 22% above where they were a year ago. Consumer debit and credit transactions are in light purple here. Again, there was some disruption early on. Spending did drop across the board, but mostly that's recovered and it's about 4% where it was a year ago. What really hasn't recovered are the travel related indicators. So hotel occupancy is down 32% relative to where it was a year ago. Travel and navigation app usage in gray down 40% versus a year ago this time. People are sticking around their neighborhoods. They don't really need to open Google Maps. Seated diners, restaurants have opened with limited capacity or maybe outdoor only seating, but seated diners still down 43% year to date. And then finally, in light blue, TSA traveler traffic is down 70%. Air travel, we think, is one of the last things that will come back. We think it'll be a long time before people feel comfortable flying. We have friends who flew from Taiwan to San Francisco yesterday, and their report was that there were 10 people on the plane wearing full hazmat suits. So definitely there's some fatigue in this pandemic, but air travel that's not necessary seems to be the one thing that people are able to delay or put off until it's safe. So now we're moving into some of the more traditional economic data. Total non-farm payrolls is kind of a fancy word for jobs that are not farm jobs. And this is looking at jobs going back a couple of years. Of course, that steep cliff, that steep drop off is the pandemic hitting. Jobs in the US went from 152 million to about 130 million. So there was a loss of 20 million jobs. Now that's partially recovered, but at the end of the day, we're still down about 10 million jobs from when the pandemic began. So the labor market as a whole has not fully recovered at all. This chart is showing gross domestic product, or GDP. That's kind of the traditional indicator for how's the economy doing. That's shown in blue here, and it's a quarter over quarter number. The S&P 500 is shown in orange, and this goes back to about 2007. And there's a reason for that. What's really interesting here, the latest reading of 31% decline in gross domestic product, that's about 3 times the decline seen in the depth of 2009 in the financial crisis. Conversely, the S&P took about several years to recover the losses that were experienced in the financial crisis, whereas we've already seen a full recovery in the market in 2020. So this chart really does illustrate the delinking between the stock market and the economy. So I mentioned one of the reasons for the stock market recovery is this unprecedented amount of stimulus. This chart is showing the Federal Reserve's balance sheet going back to, again, 2006, before the financial crisis. So this very large spike on the right is the coronavirus relief stimulus. So the Federal Reserve has been purchasing assets to put money into the economy and has expanded its balance sheet by about $3 trillion in a matter of weeks. If you compare that to these other bumps kind of over here on the left, those are the quantitative easing, or QE, programs that were put in place by the Fed following the financial crisis. So what's interesting is you're almost seeing the same magnitude in 2020 that we saw over the past decade in 3 separate waves. The federal government, as I mentioned, has also passed a number of stimulus measures to support the economy. This is a busy slide, so I apologize for that, but the area to focus is right here in the bottom left. So far, we have seen $2.4 trillion of fiscal stimulus. That is just shy of 12% of GDP. So for reference here, after the financial crisis, the International Monetary Fund, or IMF, recommended that countries put in place fiscal stimulus to the tune of 2% of GDP. So that's 6 times what we've seen, or what was recommended back then. At the time, the US passed the American Reinvestment and Recovery Act, which was close to $800 billion, which was about 5% of GDP, but that was intended to be put in place over a decade. Whereas in this case, we've seen 2.4 trillion passed thus far. It's widely expected that there will be another stimulus bill, and that one is needed to continue to support the economy this time around. So really, truly colossal amount of fiscal stimulus that's been put in place. Over here in the bottom right, this chart shows the federal net debt as a percentage of GDP, and the area to focus is in the forecast. So this dashed blue line gives a forecast that shows that net debt as a percentage of GDP is expected to reach 125%. So that would exceed the levels seen in the 40s and 50s after World War II. In addition to expanding its balance sheet, the Federal Reserve immediately took its target Fed funds target rate to 0. The Fed has also telegraphed that it plans to keep rates at 0 for the foreseeable future, at least out to 2023. Inflation, the Federal Reserve is kind of tasked with managing inflation. And this chart is showing inflation going back about 20 years. What's interesting is that despite the quantitative easing or the stimulus programs put in place after the financial crisis, we didn't see the hyperinflation that that some people were forecasting. And in fact, in 2020, we've seen a sharp decline in inflation with a very significant drop off in demand. The Federal Reserve has said this time around that its target is 2% inflation, but if we start creeping above that level, the Federal Reserve has pledged not to put in restrictive measures. Will actually let the economy run a little bit hotter this time around. So I mentioned before this K-shaped recovery, which we think is the most likely scenario from an economic standpoint. One of the impacts we think that might have is that it could exacerbate the income and wealth inequality in this country. This chart is showing the share of income captured by the top 1% going back to about 1917. So since the 1980s, inequality has been growing, or it has been getting more unequal in the United States. We actually think that this pandemic could be an inflection point to make that even worse. I think the stock market and economic impacts of that inequality are maybe up for discussion, but nonetheless, we do expect that this will shape the political landscape in future years. So speaking of politics, we have an election coming up. We're not in the business of predicting an outcome as far as who wins. But what is interesting about this 2020 election is the stock market's reaction to expectations. So traditionally, stock markets tend to favor Republican administrations which tend to come with lower taxes and lower regulations. Now, in this case, a Biden administration could actually be a positive for the market for a couple reasons. Number one, there's an expectation that tariffs will be repealed or decreased, and that we might exit this trade war that has rattled the market a little bit for the last few years. The other potential outcome is if we do see a Biden administration, the expectation is that a very, very large subsequent stimulus bill could be passed, which could power the stock market higher. So the market has been rising as Joe Biden has risen in the polls for those two reasons. The other thing to consider is that there's the possibility we could see a contested election result. That would be a negative for the stock market. But again, as Joe Biden has been rising more recently in the polls, the market's been reacting to a lower chance of a contested election outcome. So Nelson Roberts has been busy this year. This slide is showing the transactions that we made in the second quarter. So early on when the pandemic hit, some of the changes we made in our portfolio. We recognized early on that despite the fact that, as I said, everything was down, there were actually companies that would benefit from this pandemic. Apple, we bought a position in Apple, and we bought one in DocuSign. We recognize that companies will still want to be productive and execute documents, and people will still need to work remotely. So we purchased those technology names in anticipation of that. We sold our position in Hexcel and United Technologies. These are two aerospace companies that had been levered to an aerospace super cycle, or kind of the future air travel increasing globally. We saw that change quickly earlier this year, and acted by selling those two companies out of our portfolio. We also sold our position in TJ Maxx, which had been a long time holding. TJ Maxx its entire business model is kind of the treasure hunt aspect, which really depends upon foot traffic to its brick and mortar stores, which of course was really put on hold for a long time and is still not recovered. We also sold our position in Schlumberger, which is an energy company, and we kind of saw the writing on the wall when the pandemic hit, and we didn't see a recovery for oil prices. This quarter, or in the third quarter, we're now taking an eye to what are some companies out there that are relatively attractively valued that might have a benefit from this pandemic, but a benefit that won't go away. So what are the genies that can't be put back into the bottle? So we purchased a position in Adobe. It's a technology company. It's transitioned its business model to be recurring revenue, subscription based over the past few years. It's definitely seen a boost from the remote work environment, but we think that trend will endure beyond the pandemic. We bought a position in Trane Technologies, which is a heating, ventilation, and air conditioning, or HVAC company. We think eventually when people do return to their office buildings and start going out again, ventilation in commercial buildings will be extremely important, and there could be an upgrade cycle that Trane would benefit from. We bought a position in Quidel. This is a healthcare company that came out with a 15-minute rapid antigen test for COVID-19. What's interesting is it's a point of care test, which means you collect a sample and produce the test result without having to send the sample to a lab. Of course, that will be extremely important to distinguish in this upcoming flu season between flu and COVID, both of which have a lot of the same symptoms. But we think that the theme of point of care testing is, that's a reason to hold Quidel even beyond this pandemic. We bought a position in Chewy. This is a pet online retailer, which has benefited from record numbers of pets being adopted since everyone's home now and able to train a puppy. It's also benefited from the fact that it's an online retailer and doesn't require anyone leaving their home to go to a pet store to purchase goods and supplies. Even still, we think that Chewy's benefiting longer term from the theme of the humanization of pets. So people treating their pets like their babies, being willing to spend more money on them, we think Chewy will benefit. And finally, we trimmed our position in Alphabet, the parent company of Google. We mentioned earlier, we're concerned about market concentration, so we wanted to trim our exposure there. We also see some specific regulatory risks facing Google, as well as its exposure to the travel and leisure sector. So we trimmed our position back a bit there as well. So we've seen this miraculous and very dramatic market recovery, and there are some explanations for it. The fiscal and monetary stimulus, both from the government and from the Federal Reserve, have helped propel stocks forward. We've seen progress on the vaccine front. There's a hope that someday we can all return to normal in a somewhat orderly and quick fashion. That fear of missing out and there is no alternative, those two factors have driven this market higher. Corporate profits, while still awful, have been better than feared. And then those top 5 holdings in the S&P 500 have pulled the entire market higher. At this point, we think that equity valuations are stretched and we're flirting with euphoria, and we think the concentration in the market is high, and those are 2 concerns that we have. As I mentioned earlier, the data from the economy, or the economic data, and the equity markets are delinked completely. We don't see any inflationary pressures. We don't see any meaningful yield in the fixed income market. And we are looking for companies that are undervalued, that offer opportunity throughout the rest of the pandemic and beyond. So with that, I will turn it over to Evan, and he can start the Q&A.
Thanks, Darcy. We've had some good questions roll in. Again, click that Q&A box and type your questions in. Don't worry, I won't call you out. No need to be embarrassed. So the first one is a really good multi-part question about debt. I'm going to ask Brooks to answer this one. Outstanding U.S. public debt is now 100% of U.S. GDP. Every second, it seems, some country in the world takes on more debt. How does this debt reckoning affect portfolio positioning?
How much more can more sovereign debt can the world absorb? That's a really good question. This is a complicated matter that's going to be difficult to answer in a very short period. Actually, I think now the debt is well over 100% of US GDP. Understand that around the world this is true, and in Japan, I believe debt to GDP is now above 200%. So we've long been concerned about this. I think it has a good bit further to go. The only example that we have to look to is what occurred post-World War I in Germany. We've studied that. The data is not particularly reliable, but Germany basically financed the latter stages of World War I and all of the reparations from the Treaty of Versailles by printing money. And you've heard the story of the wheelbarrow full of cash to buy a loaf of bread. We're a long way from that, but we're headed there. And so it's something to be concerned about. And as the amount of sovereign debt around the world continues to grow, there'll be a turning point, but we don't think we're anywhere close to it today.
Okay, great. We've got another question in regards to the election. What are our feelings towards the outcome of the election, and how will that affect portfolios? Steve, do you want to take this one?
Yeah, sure. So I'll just echo what Darcy stated. I think the short answer is we don't see the outcome of the election having a material impact on the stock market. We think based on the polls, if the Democrats take the White House and potentially the Senate, that's been priced in. If the Republicans maintain control, there won't be any surprises there. It'll just be status quo. And like Darcy said, probably the biggest risk is if we have a contested election. So if we don't get an answer within a few weeks or a few months, the one thing the stock market doesn't like is uncertainty, and that would present that scenario. But again, that's a short-term problem. I think history has shown that the markets are pretty resilient when it comes to these election cycles. So typically, it's the outcome doesn't really determine what the market's going to do in the short term.
Thanks, Steve. We've got another question in regards to IBM. Although it's off our buy list, we can certainly talk about it. Darcy, do you want to answer this one? What do you think the likely outcome will be with the breakup of IBM?
Yeah, that's an interesting question. I think initially when they announced that they were making those moves, the stock reacted positively. And I think the reason for that is there's an expectation, IBM's kind of one of the dinosaurs of the tech, it's maybe one of the only value stocks that's in the technology sector. Its breakup, the aim of its breakup is really to focus its entire business on AI and cloud, which are the two areas of growth that are being seen at IBM right now. So as I said, we don't own it in most client portfolios anymore. We don't follow it extremely closely, but that's the initial impact, or that's the initial reaction from the stock market. And that's kind of my initial takeaway. But I think we also will have to wait and see how it plays out.
Okay, we've got another question on the markets. Brian, do you want to answer this? What are you watching as indicators that the market is correcting?
Thanks, Evan. Well, as you know, Darcy explained with the K-shaped recovery, it's difficult to look at the economic indicators as signs that the market, where the market should be priced. Really, it's the infusion of capital both on a fiscal basis as well as the monetary basis that has fueled this growth. So it's really watching, the change in the stock market on a day-to-day basis, seeing if dips continue to be purchased, and looking out ahead in the 3, 6, 9-month timeframes to see if that type of stimulus will continue in the stock market. Right now, it's responding to the fact that there is additional fiscal stimulus anticipated. And as long as that is in place, we think that the stock market will maintain its level, if not creep higher. As Darcy also mentioned, there is the TINA trade in the sense that the alternative being fixed income in the liquid capital markets is not particularly attractive. The dividend on the S&P 500 at close to 2% is more than double that of a 10-year treasury bond. So even if we're looking at the income being generated from the respective investment choices, stock market continues to be attractive on a mid and long-term basis, which we think will continue to support the stock market.
Thanks, Brian. We've got another equity question. Darcy, I think you can handle this. What is your take on Tesla? I was surprised to find out it's not in the S&P. How about electric vehicles energy market?
Yeah, that's actually an interesting question from a couple of reasons. Tesla has been certainly a very exciting stock this year. It almost is one of these stocks that doesn't really trade on fundamentals. It's more trades on excitement about the company. So, I think the electric vehicle or energy market, we actually did start looking at alternative energy companies, which are traditional. Tesla is actually a consumer discretionary stock, I believe. Alternative energy companies surprisingly don't fall into the energy sector. They're in technology for the most part. We did start looking at that early on. It's been a wild year and tough to execute on things in time. And what's happened since there's been a gain in the Democratic, in the polls for Joe Biden, is that that's become kind of a crowded trade because there's an expectation of some kind of Green New Deal that would come with a Democratic administration. It's way too far. It's way too far in the future to actually make an investment decision based on that. So we think that there will be another opportunity, whatever that might look like. But it is definitely a space we're watching.
Thanks, Darcy. Another question here. Are you recommending any allocation percentage changes? Steve, do you want to take that one?
Sorry, unmute. No, we're not recommending any allocation changes at this time. We still think fixed income has a place in portfolios, even though yields are extremely low. What we are looking at, and Darcy references, is looking to shift from higher growth equity names into more value oriented, so higher dividend paying equity opportunities. So we're looking at making a shift within the equity allocation, but at this point, even with the elevated valuation of the stock market, we're not recommending making any allocation changes between equity and fixed income.
All right. And then we've got a question here. I think, Brooks, you can handle this. Are there opportunities overseas, like in Taiwan or New Zealand?
Can handle it if I can get my thing unmuted. Thank you. There are always opportunities overseas. In aggregate, you saw in the early part of the presentation, the emerging market stocks have underperformed in the US. I think we're going to see that come back. It'll probably, I think the foreign markets will, in aggregate, especially emerging, will come back when we get through the economic recovery, and who exactly knows when that is, no one can say. New Zealand is a little bit special because their record on handling the pandemic has been an example to the world, and they and Korea have just done an incredible job. So yeah, I think there's going to be some opportunity there because we're likely to see the economic recovery in those countries coming first.
All right. We got a question. We're all on a Zoom right now, and it's quickly becoming the Kleenex of video meetings. Where do you see it going? Darcy, do you want to handle this?
Sure. Yeah, Zoom, wish we bought it, certainly. Zoom is an interesting stock, and it definitely is becoming ubiquitous. And I can't imagine a better environment for this company to do well, honestly. There are competitors out there, but really we're all in a Zoom meeting right now, and that's becoming their virtual vehicle of choice. Right now, I think it's a valuation issue. So, Zoom does make money. It's a relatively new-ish company. Went public in 2019, about middle of last year. But if we look at the price to earnings ratio, it's almost 670, which is kind of nonsensical. So even we can look at, what is the price to sales ratio, which is sometimes a better metric for these high growth companies. But even the price to sales, it's currently trading at 104.
Did we lose Darcy?
You may have. Sorry, Darcy, your mic is off. So we will move forward and come back maybe. Again, we're all on a Zoom, and there's issues too. So, okay, we've got another question. What is the effect of, what is the effect on the market and the economy on increasing concentration of wealth, in addition to the possibility of societal instability? Brooks, do you want to take this one?
Oh, okay. I think that the concentration of wealth is something that can go on for a very long period of time. Some of you have heard me mention this book before, but Professor Walter Scheidel at Stanford wrote a book called The Great Leveler, A History of Violence and Inequality from the Stone Age to Present. It is without a doubt the best sleeping pill I've ever taken. But what he says in the course of page after page after page is that there are just 4 real fundamental causes which cause wealth concentration to dissipate. And quickly, they are pandemic, not like we're experiencing, but like the Great Plague, where we had 1/4 of the world population die. They are revolution, not our revolution, not the French Revolution, but the Russian Revolution and the Chinese Revolution, where a lot of the wealthy people not only lost their wealth but lost their lives. The third impact is state failure, and that would be along the lines of what occurred to the Roman Empire. It lasted for 1,000 years, and between 400 AD and 500 AD, it just disappeared. It disappeared. I'm missing the 4th one. I can't remember what it is. It'll come to me in a minute. The 4th one is war on the scale of World Wars I and II, where you basically have societies fighting to the death with every fiber of their economic ability. Notably in here, and Scheidel points out that governmental policy, taxation are not causes of wealth dissipation. They're actually, in fact, historically, they're causes of wealth concentration. In ancient China, one of the best ways to become a wealthy person was to become a tax collector. So it's a long answer to a complicated question. I think it's going to take a very long time to sort it out, and I don't know if it'll even occur during our lifetimes. Well, maybe in some of your lifetimes, and probably not mine.
Thanks, Brooks. Okay, another question here. What about other investments? Preferred stocks, hedge funds, commodities, etc. Steve, do you want to take that one?
Yeah, so we're always looking at, and part of our research team, one of their jobs is always looking at alternative investments. So we do look at preferred stocks. We've looked at commodities as well. Hedge funds is not an area that we typically or historically have invested in. There are issues with each of these. Preferred stocks tend to have higher income, but they're very interest rate sensitive. So if we expect interest rates to rise, preferred stocks tend to perform poorly in that environment. Commodities is an area we're looking at. If inflation takes off, we think commodities would be an area that we would look to invest and should perform well in that environment. But yeah, no, we spend a lot of time focused on equities and fixed income. But in this environment, especially on the fixed income side, with interest rates being as low as they are, we are looking at alternative investments as a way to generate more income in this environment.
Okay, great. We've got another question here on the medical side. Anne, I think you can take this one. When do you think there will be a vaccine?
There are, as you all know, a lot of efforts underway to get a vaccine out to the world. I think that a vaccine will likely be widely available starting next summer, so summer of 2021. As I read everything that's out there, both the medical news, the pharmaceutical news, the government news, the 4 leading efforts that are occurring in the United States and or the UK all look like they're moving in a way that they should probably be applying for approval, at least emergency approval, sometime between December and probably February. The plan right now is to roll out whatever vaccine might get approved to healthcare workers and other people at high risk initially, and then to have a phased rollout to the rest of the population, again, focusing on people at higher risk. For example, nursing home residents, nursing home resident workers, people who work in the retail environment where they're frequently exposed to multiple people in a customer-facing way. But my money is on wide availability starting summer to fall of 2021.
Thanks, Anne. Okay, another question here. Will the hold on required IRA distributions have an impact with extra cash available? Brian, do you want to take that one?
Sure. So the question is referencing in 2020, the required minimum distributions are in fact not required to be taken this year, which provides an interesting planning opportunity for many clients. In the absence of that income, oftentimes people's income tax brackets are dropping and presents an opportunity to either realize gains or income from other sources, or take that income and put it into a Roth IRA. Keeping it invested in the IRA that is now not required to take that distribution also will keep the investments in place. So it is helping to support the stock market, but I think that it presents a better opportunity for some planning around not having that income in 2020.
All right, thanks, Brian. And the last question we have right now is, in the event of a Biden administration, what would the effect of the US rejoining the international community, in particular, the fight against climate change? Steve, do you want to take that?
Yeah, as we always do, we try to stay away from taking a political position on this. Yeah, I may defer this to Brooks if he has any input on this one, but I think it is in the best interest of our country that we have stability both here in the U.S. and internationally. And whether or not you believe in climate, the climate warming up, I think we can all agree that there is climate change going on, and that needs to be dealt with at a scientific level. So yeah, it's something that we look at the companies we're investing in today, and it is at the forefront of most of the S&P 500 companies is how they're going to deal with both international relations, but also how they're going to deal with a changing climate throughout the world.
I don't have anything to add, Steve. Good job.
All right. Well, unless we've got any more last minute questions, just like to thank all the panelists and Darcy for the great presentation today.